Hello and welcome back to the Note. The Bank of England is taking measures to try to avert a potential housing bubble. Why is it doing that? Are these measures going to work? Well, our property correspondent has been crunching the numbers. She's Kate Allen. Kate, thanks for joining me once more. Let's start by taking a look at the total amount that British families pay on mortgage interest. And somehow or other, despite all the huge boom in house prices over the last decade, we're exactly where we were a decade ago. How has this happened?
Yes, well, this shows the impact of the historically low base rate of interest on British households' expenditure. Owner-occupiers are paying the same amount in mortgage interest that they did a decade ago. That's a 10-year low.
Even though we've had this great rise in house prices over the same period. Now let's take a look at how that affects the all-important balance between renting and owning. These are numbers Savills put together for you. And quite extraordinarily, the interest charge that you pay as a private owner is actually slightly less than the rent that a social tenant pays.
Yes, Savills modelling shows that at the moment, mortgaged owner-occupiers who are paying interest only are on average paying less than the rent a social tenant pays on their home. Now, 2/3 of households with a mortgage are on variable rate loans, a surprisingly high proportion. And so they will be the people who any future rise in interest rates will affect most immediately.
2/3. Now I can remember more than 20 years ago writing about how the UK had this unique predilection for variable rate mortgages and how it affected monetary policy, that central banks didn't want to raise rates when so many people are on a variable rate. How have we reached this situation? Why don't people want to fix at such low levels?
Well, I think it's a kind of a psychological aberration that at the moment fixing looks expensive compared to your variable rate. People aren't thinking about the future. And the time when it's most psychologically tempting to fix is when interest rates are likely to go down, which makes absolutely no economic sense.
Okay, so we're obviously in a position where some very strange things are up, where you can see why the Bank of England would be worried. Now let's try to answer their question for them. They wanted to know what would happen if interest rates went up by 3 percentage points. Take me through this chart.
So here we are showing what the average household with a mortgage is paying on their mortgage interest costs at the moment. That's where we are, 0.5%, so just below £4,000 a year. Now, if interest rates were to rise, the base rate, these figures are the base rate of interest, it's important to see that, not the average mortgage rate paid by people. If the base rate goes up to 3%, you're looking at that almost doubling. Now, the Bank of England's own research showed that 8% of households with a mortgage are currently paying a high level of that proportion of their income as their mortgage interest payments. And they expect that to double to 16% of households if the base rate rises to 3%.
Okay, so that appears to suggest that the bank is extremely right to be nervous about this and to be trying to put some limits on it. How dangerous is the situation at present? Is there anything that could bring house prices down before we start seeing interest rates rise?
Well, I think there's a geographical element to this, that it's, as ever, it's a story of London versus the rest.
Right.
The rest of the country is much more vulnerable to house price falls than London is. London's economy means that it's very hard to see how a supply-demand imbalance fundamentally could change. I think the other important thing to note is that this kind of modelling is the kind of modelling that mortgage lenders are already required to do, particularly since the Mortgage Market Review came into effect earlier this year. We haven't really seen the effects of that fully taking hold yet. So some people in the property industry actually argue the Bank of England should hold off and wait to see what effect that has on lenders. We're already seeing signs that lenders are scaling back because of it.
Okay, Kate, thank you very much indeed. We can at least, I think, see why the Bank of England is worried, and I think we can agree that they should be worried. Personally, we've had over 20 years to try to fix this problem since the big boom followed by the bust of the late 80s and the early 90s. We've had two parties trying to deal with this. We've had a coalition trying to deal with this. It is rather worrisome, looking at the UK economy, that we continue to leave ourselves open to the wild vagaries of the residential housing market.